David, we got not just Clarida, but Bullard now and Bostic and George. Is any color changing from those four today?
So I think what you're seeing is that the Fed is taking a look at the world, and they're looking at the interaction of fiscal policy and the economy and kind of this global dynamic. And they're saying, you know what, growth looks pretty good, but we think growth is going to slow back down next year. Inflation is really not a problem. I mean, even when you look at that wage print of 3.2% from the most recent jobs report, when you factor in productivity, that's consistent with inflation around 2. And so I think what the Fed is saying is, look, we think growth is going to be okay. It doesn't really feel like inflation is going to be a problem. We're getting very close to our estimate of neutral, so perhaps over the next couple of months they'll begin to signal some sort of pause. That's been our view all along, and I think maybe a hike in December, 2 hikes next year brings them to neutral, and then we get a little breath of relief from our friends at the Fed.
Jurrien, I mean, they're still out there with calls for 4 more hikes, 5 in the case of, I think, Goldman. Did today change your view? Or is it changing the overall consensus, the rhetoric we're getting this morning?
It does. You know, ultimately everything comes down to the same 3 things that I always talk about: earnings, liquidity conditions, and at what valuation those 2 realities are reflected. And, you know, back in January when the market sold off, it was just the stock market. You know, credit spreads were well behaved, the ISMs were making still new highs. So that was never going to be enough to sway the Fed. But now, in recent weeks, you know, credit spreads have gone up. I mean, not in a huge way, but the high yield spreads are from 300 up to 425. The stock market's down. Tips break evens have dropped meaningfully. As David just mentioned, inflation is not an issue. So the Fed has much more cover now to, you know, not stop its hikes, but to slow them down, and maybe instead of 5, as the dots suggest, maybe go to 3 or 4, and instead of doing 4 over 6 quarters, they do 3 over 8 quarters. And, you know, one lesson that we've learned over and over in this rate of change world is that less tightening is the new easing, right? So in 2016, the Fed kept tightening, but it slowed down its track, and that was enough for liquidity conditions to ease up, the dollar to come down, and the markets to reflate. If the Fed does the same thing now, I think that would be a significant lift for the market in 2019. And, you know, the 1994 cycle, even though that was a very long time ago, was instrumental in how that dynamic worked out.